You are pretty favorable, pretty optimistic on consumer stocks overall, right?
Yeah, so consumer was the biggest underweight we had the first six and a half months of the year. And we've been adding, pretty aggressively there over the last couple of months. And I think it sets up as a pretty interesting contrarian trade right now. So we're telling people go long the consumer discretionary stocks, short the banks right now for the fourth quarter.
Even though both are cyclicals.
You're right, they have commonality of exposure to fundamentals. Actually, the net income are correlated by 0.8, retails and banks.
Really?
Yeah. The reason is housing, employment, rates, those things feature into both. But I like consumer right here because comps are going to be easy from a year ago. You order apparel in kind of April, May for Christmas. They ordered way too much in 2013. They learned the lesson and they ordered less this year. So sale pricing won't be as aggressive. Inventory won't be as aggressive. You've talked about oil being at the bottom end of the range.
Yeah,
that helps the consumer. I think expectations and sentiment are far lower. If I look at maybe the banks, the stocks have done really well the last kind of 6 weeks on a relative basis. Yet the 10-year yield didn't really back up to release the NIM pressure. Housing, the second derivative slowing. So I kind of think as a contrarian trade, I'd rather own some of these into the fourth quarter, into the Black Friday kind of noise that you guys will be talking about in a few weeks.
Yeah, isn't that mind-boggling? It's already...
it's October.
I'm waiting for Christmas decorations
in
Bloomingdale's.
Couple pumpkins first, and then we get to the Christmas.
Yeah, right. So you look at retail over the past couple of years. Last year there was a problem with UPS getting the shipping. There was also the bad weather that lowered sales. The year before that, the consumer didn't have money. Is there a bugaboo in retail this year?
I don't know. I mean, we have a macro indicator that shows that some of the stuff is really starting to inflect at the low end. I do think this oil thing is crucial that you mentioned. I think it just costs people less at the pump, and that makes them feel a little bit more flush into the holiday season. Yeah.
You've also been looking at deal making. It's a good way for companies to plug the earnings gap, and the strong U.S. dollar kind of changes the tone for U.S. companies looking to make acquisitions, doesn't it?
It could a little bit. Look, I think you're going to get the second wave is more conventional M&A, where big U.S. companies buy small U.S. companies, right? I think the key is that the acquirers, the stocks actually have been going up.
Yes, that's a distinction.
When I started in this business, nobody ever said anything other than the deal will be accretive in year 3. Because they knew it wasn't in 1 and 2, and they just thought, by 3 it'd be fine, right? So I think right now these things are accretive much faster, if not immediately, and so the acquirers are interested. And I think the other thing that's important to note is big companies that are doing buybacks in the last year have actually been underperforming big companies that aren't. So it's almost like the market's giving a message saying, hey, you guys can't really grow fast enough to offset that.
Yeah, in other words, go use your cash strategically. Don't just buy back stock and engine or higher earnings.
We need growth, right? So I think the signs are there that you could get some more M&A picking up, to be honest with you.
How come we haven't seen as much intensity among the small and mid-cap stocks when it comes to M&A?
Because I think the first wave here was about the tax arbitrage and inversion, and you've seen a lot of that in healthcare and other areas.
So is that over?
Well, the government's trying to obviously do some stuff to make that a little less.
And some of those deals are going forward in spite of it.
Yeah, because they make sense, even above and beyond that in many cases. But I think you'll see with cost of capital low, with confidence slowly improving, that happens. And look, the other thing they could do is capital spending, and we know high capex to sales companies underperform low capex to sales companies. So I think it does make sense that this is a natural evolution of where we head in the next couple of years.
Yeah, right. I remember 2 years ago when you had been a bear and you switched to a bull. People were like, "It's been a 3-year run." You said it's going a lot farther, and you were.
Yeah, we could be 10 years. We'll see.
Right.